Hey everyone, it's John. It's time for a general market update. It's July 30th, 2022. Just as a reminder, this is a presentation by Rain King LLC, and I'm not affiliated with MarketSmith or IBD. So today's market update is going to do a little bit of general analysis. We'll talk about some of the internals of the market that have been shifting in a positive way. Then we'll talk about the latest rally attempt and look at some history for some guidance. And then we'll look at some of the most recent leadership. As we always start with the big picture, I wanted to come back to the super cycle concept. That is a concept that from 2009 to 2035, we could be in a major bull super cycle. And it was really driven by the 84 million millennials that have entered peak consumption years starting in 2019. We know there'll be bear markets along the way, but the most powerful force is the consumption, the peak consumption. There's probably a 15-year window ahead of us where millennials will be consuming and using cars, houses, insurance, financial services, combined with the boomers that are using healthcare, second homes, and also transferring wealth. So as this relates to the NASDAQ, this is a monthly chart that I've used the last few years, and it shows how I've been saying as this bear market has developed, I had flagged that long-term support shows that we could come down to the 11,000, even as low as the 10,000 level in the NASDAQ, and still be within the long-term trend of the super cycle. The current lows on the NASDAQ are 10,565, so we're right in that zone where we were expecting to see some support, and we did get some support this week. So let's examine the market internals. This is the New York advanced decline line. I've shown this kind of downtrend line that has been broken, and you'll also notice it's a little bit subtle, but you'll notice that the advanced decline line is about to make a new high relative to where it was in June. And you'll notice that the S&P 500 index is a little further below that. It would be very positive to see the advanced decline leading a short-term high before the index were to make a high. It's just reinforcing that the breadth of the market is getting stronger than the index. This is the NASDAQ advanced decline volume ratio. And what's important about this is it's showing you the volume on the advancing issues versus the declining issues. And you'll notice that we've exceeded the March highs from the March rally that we had. Yet the NASDAQ as an index is still well below the March highs. Again, this is starting to show to us that some of the positive breadth that's coming in underneath the market as we start this rally attempt. I wanted to show the University of Michigan Consumer Sentiment Survey. The long-term view is on the left. This goes from 1962 to today. And you'll notice we are down at levels below 60. And that has really been only achieved during bear markets. You can look at the lows in the 08-09 period, the double dip recession in the 70s, and the 1973-74 bear market and recession is the levels of below 60. I did mark, just as a point of reference, the euphoria of the 2000 top, which shows extremely high consumer sentiment during a very bubble period. Now, on the right side is just the last 4 years of the consumer sentiment index. And you can see we've just been falling off the table in the last year or so. And, we're down in the dumps, and we're talking about this before, that the news is going to be horrible when the market makes a turn. And the news has been horrible. There's a lot of concerns about recessions and rates and world events. So it's important that we were at low levels, which again is a positive contrary indicator. I used this slide last time. And again, this is another kind of sentiment look. And I had shown the last two bullets said we should watch the earnings reactions in this earnings season for sentiment. If growth stocks go down on a poor report, then the market may be still discounting weak economic growth. Conversely, if growth stocks stop going down on a poor report, it would be a clue, not a buy signal necessarily, that maybe the worst is over for growth stocks. So I just tabulated over the last 3 weeks some of the earnings reactions and what the report was relative to what was the reaction. You can see Tesla came out, good report, good reaction. Now, I think the next two are really important. Microsoft and Google had misses, but they had very positive, good reactions with their stock prices. Chipotle was good. There were a few blow-ups. Snap had a miss and gapped down badly. Shop as well, but those are former leaders. We also had a very positive beat and raise report from Enphase, and it gapped up strongly. Other FANG stocks, Meta and Amazon had misses, but generally got support, or Amazon had a very good reaction. So the general message from this is, as sentiment is, even during misses, the market is looking forward and starting to mark up the FANG stocks again. So that's a contrary indicator, but it's something I look at just to get a sense of how the market's reacting. Let's get into the current market. So this is the NASDAQ composite. On the left, I wanted to just show the progress that's been made over the past month. We had the 5th follow-through day in this bear market in late June, and we had a 3.34% increase. From there, though, we had some problem. We had some distribution. The market continued to try and rally. It rallied into the 50-day once, pulled back, and it tried to rally again into the 50-day. And that was when the CPI report came out at 9.1%. And things didn't look good here. We had distribution in the index. We had a very hot CPI report, and we ran into the resistance at the 50-day. But the market regained its footing, and we had 3 very strong days that took us through the resistance of the 50-day. We had gains of 3.1%, 1.6%, and 1.4%. Very strong, and the volume came in, which is a positive. Then on the actual day that the Fed raised rates by 75 bips, we had another accumulation day in the NASDAQ, 4% gain, very, very positive. Now on the right side, again, this is the same NASDAQ chart, but I wanted to look at it from the perspective of new lows. We're always looking for divergences to help us confirm some of the internals of the market. So on May 12th, we had a low in the NASDAQ, and we had 1,702 new lows. A week or so later, on May 20th, we made a new low in the NASDAQ at 11,035, but the new lows started to dry up. We had 477 lows. And then on June 16th, we made a new low in the market, and the new lows were at 1147. So that's an important marker for me in looking at things, because we went from 1,702 new lows and a major low, and then the new lows significantly were less as the market made a low. Now on the right side, in June 30th, we started to rally, and we made a higher low, and you can see that the new low shrunk to only 532. Then 2 weeks later, we made another higher low in the NASDAQ, and the new low shrunk again to 447, positive. And on July 26th, when we had this pullback into the 50-day, we actually only made 172 new lows. So this decrease in new lows is really a positive sign that the market internals and breadth are improving. And on Friday, we had another accumulation day in the NASDAQ, a 1.88% gain, and pretty significant. It was done on a Friday. Typically in bear markets, people don't hold positions through the weekend, but this shows that people were willing to hold as we had a good close. I just put the 2018 bottom on the screen because I wanted to share that same characteristic, that after you have a follow-through day, we want to see more accumulation days in the index. And so you can see on this chart, here's another 1.03% gain, 1.3% gain, 2.2% gain. Continued accumulation days are what we want to see to show that the rally has legs And so far, we're starting to see that in the current market. So this is a slide from my February 27th general market update. And in it, I had said, what would we be looking for to see if a bottom was starting to be formed? And I said, rally attempts with breadth improving in the advanced decline line and leading stocks. Check. We're starting to see, as I've shown, breadth improve. A positive divergence, I said, would be number 2. Again, looking at the new lows, and I've shown you the positive divergence we've seen in the new lows. That's a check. A strong follow-through day, at least 1.3% minimum, prefer 2 to 3%. We have had a follow-through day and a couple of subsequent follow-through days, so that's a positive. Sentiment, I showed, the sentiment of the Michigan survey. Definitely sentiment in the AAI survey. We've been extremes for months. So I guess that is also a positive piece of the puzzle that's in place. The news will be horrible. There's no doubt the news has been really bad with inflation talk, rising rates, et cetera, et cetera. The next one was growth stops would stop going down on bad news. And this is why I wanted to show that earnings reaction table, because there were some misses by some of the FANG names and they stopped going down and actually went up. That's a significant thing to take note of. Then quality bases and new names and relative strength. We have seen some of the emerging leading stocks. We have not seen a plethora of bases yet. But again, I show this slide to say this is what we were looking for back in February, and we're starting to get almost all the boxes are starting to be checked off. So this rally attempt and a little look at history. So here we are again with the NASDAQ. The red line is the 50-day moving average. The black line is the 200-day moving average. And I've kind of shown this bubble to represent a zone between the two moving averages. How far will this rally go? If we were to rally up to the 200-day, that's about a 12% gain in the NASDAQ. That would be significant. And if you're in the right stocks, it's definitely a tradable rally. And maybe it's the start of a new bull market. So this zone is something I wanted to look at with some other previous market precedents. So here is the 1990 market bottom. And I wanted to show this zone of a rally. You can see this rally here. I've got the orange zone. This is above the 50-day, and the top of this bubble is representing the 200-day. And you can see in 1990, this rally went all the way into the 200-day moving average before we reached some resistance and came back, and we actually broke the 50 and had a retest. Now that retest occurred 3 months after the low was put in. I'd also like you to notice that here's the period that we were in an 8-month mild recession. And you'll notice that the low of October was put in well before the recession ended, which wasn't until the end of February in 1991. So this is a case where we rally all the way up to the 200-day. If we look at the 1962 bottom, again, here is the zone where the rally occurs above the 50-day, and we have the 200-day at the top of this orange bubble. You'll notice that this rally got about 50% of the way between the two moving averages, and then things started to pull back, and we started to meander back, and we did a retest of the lows that occurred about 4 months. So we went sideways to downward to do a retest 4 months after the ultimate bottom was put in. And the third situation from history I looked at was the 02 bottom. And you'll notice here's the zone where we come through the 50-day, and this zone of orange is up to the 200-day. Now this is unique in the sense that we ran from the 50 to the 200, ran into resistance, came back down, and made a second attempt to get through the 200-day moving average, which was unsuccessful. And the market came back down and corrected and had a retest. The retest held the low from October, but you'll notice that this period takes 5 months after the low was put in. So it was a bottoming process. And when you have a deep correction, as we have in the NASDAQ, there's a lot of repair work that needs to be done. So I just show those as points of reference. And we look again now at the 2022 bottoming process, and there's different scenarios. We could do something similar where we run up to the 200-day, then possibly gradually pull back over the next few months into the fall and have a retest, but we hold the lows from June. That's a possibility. Second possibility is we work our way up and through the 200-day moving average, and we work our way higher and make an assault on all-time highs. Possibility. The third is we stall out somewhere between the two moving averages. The markets come back with an attempt to potentially retest, but the retest falls apart and we actually have another leg lower in this bear market. So they're just things to keep in the back of your mind that this could take some time for this market to have a retest possibly in the fall. I've shown this chart before. This is the economic cycle versus the stock market cycle. I've moved my arrow over into this wedge that's in orange because we're actually moving in this direction. And don't forget, the market is always looking forward, anticipating. Certainly we've seen consumer staples and healthcare stocks recently start to perform. We've certainly seen 2 quarters of GDP growth that is negative, which I know there's a big debate if that's a recession or not. We don't need to argue about that. But on the left side, you'll see the stock market cycle. I've moved my arrow to say maybe we're in the mid area, middle bear to late bear. We don't know for sure, but I put a box around some of the industries that might give us clues, the financials, as well as consumer cyclicals, early consumer cyclicals. And those would be, if you're looking at ETFs, I would look at the XLY, which is discretionary cyclicals. And I would look at the home builders, which is HXB, and the financials being XLF. So things to keep an eye on. Now, some of the leadership. Before we get into that, when you're looking at charts and patterns, try to remember your context. Are you looking at a stock that is, off its highs by 50% or more, or are you off your highs by a stock that is only 20 to 30% correction? Only 20, 30% and near its old highs is a stronger situation that you may want to consider in your watch list. Certainly the emerging leadership, we want to look for stocks at new highs or within striking distance of new highs. Here's a bunch of weekly charts. Certainly Enphase and Solar Edge had great weeks, and the solar industry is showing very, very strong strength. Celsius, which I talked about in the last video, is strong. Shockwave is within striking distance of old highs. Lanth, LNTH, is also within making new highs. So those are really important things to take note of. Other watch list names that I've noted that are showing really good action, Bumble and GitLab, and you can read this list and take a look at these charts yourself. But the themes really are, there are new names in growth that are starting to set up, which is a positive. We also know that the FANG stocks and the NASDAQ 100 have shown great strength over the past 2 weeks. And I would also note that the semiconductor stocks are also starting to come off lows and start to set up in their bases. So you can pause your video player here. This is some notes I had about what to look for as you start to build your watch list and signs of accumulation. But this rally attempt, the next steps are gradually put on exposure as your positions are working. If you were flat-footed and you weren't able to get into some of the emerging leaders, it's very important to be patient and don't chase extended stocks. The NASDAQ is had such a push higher that it's actually extended from the 20-day, and we could snap back that next week. And if you're a late buyer, you're going to be under pressure. If the low is in, and if a new bull market has begun, and we don't know that for sure, there are going to be low risk entry points in the future, and you want to make sure you have risk reward odds in your favor. Currently, there really is not many full and proper base setups in growth stocks. When you have the destruction of growth, as we've seen where they're off 50 to 75%, it takes time. And I mentioned this retest in the NASDAQ that could happen, 2, 3, 4 months from now. That would allow time for proper bases and growth stocks to be fully built. So it's something to keep in your mind, something to look at. But certainly the market has improved enough to start putting on exposure. That's all the time we have for today. I hope this is helpful. Any comments you have, I'd welcome, and we'll see you at the next general market update.